Hi, everyone. How you doing? My name is Marty Karaman. I am the partner in charge of our National Tax Credits and Incentive Advisory Group today. My apologies, and I'm happy I'm moderating and I'm not speaking too much today because I'm saddled with a bit of a cold today. But let me just share our slides here for a moment. Let me get these up on the screen, and then we can begin. Okay, there we go. All right, excellent. Um, Very good. So, in this webinar, we're going to talk about direct pay, and we're going to talk about our experience with it over the past year, or maybe a little bit longer than that. It came into play in 2023. But we're going to clarify some of the complexities and unveil some of the substantial benefits for direct pay credits when it comes to not-for-profits and for governments as well. With that in mind, I want to begin by, again, introducing who you're going to be hearing from today. So again, my name is Marty Cameron. I'm the partner in charge of our National Tax Credits Incentives Advisory Group. We're a group of about 45 people at Cherry Beckert, completely focused on credits and incentives, everything from this area when it comes to Inflation Reduction Act credits, also in the direct pay area as well, but to R&D credits, cost segregation studies, state credits, and incentives as well. But I have three other people speaking with me today, and I'm going to call on them a little bit to introduce themselves. Melanie, why don't we start with you? And why don't you talk a little bit about yourself and your role here?
Thanks, Marty. My name is Melanie McPeak. I'm a managing director and not-for-profit tax leader here at Cherry Beckert, and I sit in beautiful Tampa, Florida.
Excellent. Tim?
Yeah, hey, great to be here today, talking to all of you. My name's Tim Doran. I'm a director working with Marty in our tax credits and incentives advisory practice. I focus on all things Inflation Reduction Act and energy credit in the federal tax world. I have a background. I've been at Cherry Beckert for coming up on 2 years, but I have a background as in-house counsel for a large Midwest utility where I was doing these energy credits even before the Inflation Reduction Act. And we'll talk a little bit about that today.
And David?
Hey everyone, I'm Dave Mohammadi. I'm a senior manager in our group. I work with Tim on all things Energy Inflation Reduction Act. I sit in Philadelphia, and I appreciate everyone taking the time to come to this webinar as opposed to watching March Madness.
Very good. All right, so our agenda today is as follows. Obviously, we're going to talk a little bit about some of the high-level direct pay, how it works, and its focus on direct payment, obviously, on the elective pay regime for some of the investment tax credit and production tax credits that have been available and were enhanced under the Inflation Reduction Act. We're going to talk a bit as well about those credits and some of the enhancers to getting a full credit under the prevailing wage and apprenticeship regimes in addition to domestic content. So this is another booster there as well. Probably most important, I think, for everybody on this would be the direct pay process and how you go about taking advantage of these credits and what experience maybe we've had a little bit with the IRS and seeing how quickly they've been paid. And then also the credit determination around like what costs go in it and some financing mechanisms. So with that said, I think we go to a polling question right now. This is the easy one where we'll begin. How did you hear about today's webinar? One, an email from Cherry Beckert, two, a friend or colleague, or three, in a social media post. And then Tim, I think you're next when we begin. Why don't you pull yourself up here and we can talk today a little bit. I would just say this, Tim, a question to you before we even begin. I think how's it going in terms of like identifying clients and like how many more are taking advantage of it, like today versus a year ago? What do you think?
Yeah, well, it was interesting because there's still a lot of that informational knowledge transfer piece that's going on with folks when it comes to what kind of incentives are available in the Inflation Reduction Act. And I think we're still trying to help people realize how much potential money there is out there to provide incentives, both for potential projects that maybe you've considered in your budget, in years past, and maybe now it makes sense, or projects you're working on right now that you didn't realize you might have extra money sitting out there that you can take advantage of. We continue to see that, but word is getting out there, and we're seeing more and more and more folks starting to go after the money in the Inflation Reduction Act, especially in this space.
All right, so we're going to begin the direct pay overview, and at some point I'm going to hit you with like, what are your thoughts about changing administration and how this may affect that regime? But let's begin with the overview. So thanks.
Yep. Great. Thanks, Marty. And before we even get into stuff on this slide, I wanted to address two things. One, I just wanted to talk generally about the world of federal tax credits, and then two, give the folks on the call today a little bit of a history of what the world looked like before the Inflation Reduction Act, why Inflation Reduction Act and why the Congress did what they did in the act. And then we can get into kind of the meat of what these credits are a little bit more in the next few slides. But talking generally, I know this is a webinar for direct pay, and that means we've got not-for-profits, governments, tax-exempt folks. My guess is at least a handful of folks on the call today, your exposure to the federal tax world is, sending your W-2 over to your CPA to get your taxes filed each year. So, just to set the stage for these federal tax credits, the Congress and the government have historically provided incentives to taxpayers through the tax code in two different ways. One is a deduction and one is a credit. You've probably all heard or been exposed to them in some way, but I just want to make sure we're on the same page when we talk about what these credits are and have been. A deduction is where you take your taxable income that you're calculating the taxes you're going to pay off of. So, you've made $100 and you have a 20% tax rate, and you're going to pay $20 based on that 20% tax rate against your $100 you've earned. If we have a deduction, we reduce that $100 by, let's say, a $20 deduction. You now have $80 that you're multiplying by that 20% to get a $16 payable. So you've taken your $20 tax to $16 in tax. We call that tax affecting the deduction to see what it's worth. The credits are another way in which the federal government provides an incentive for certain behaviors and activities. A credit is more powerful. A credit is a one-to-one offset of the tax you pay. So if we go back to that example, if you had a $20 tax on $100 of income, but you had a $20 credit instead of a $20 deduction, you would owe nothing to the federal government. So for federal taxpayers taking advantage of these credits, they're very, very powerful incentive, right? They're a one-to-one dollar for dollar credit to the extent that you can use them. So let's take that background into why the Inflation Reduction Act and why some of the things that Congress didn't exist, including this direct pay idea we're going to talk about today. Historically, these energy credits that we're talking about have been around for quite some time. And they were primarily used by utilities and large developers who were putting solar panels and wind farms in large quantity into service. And they could adjust the cost of energy that they were selling because they could get a big federal tax credit to pay for that. Well, the idea behind the Inflation Reduction Act was we were going to juice up these credits, but we were going to find other ways to broaden and democratize the way this incentive works. One of them that we're not going to talk about today was allowing the transfer of these credits, which allowed taxpayers who didn't have a tax liability, kind of a similar situation to not-for-profits and government entities who don't pay federal taxes, typically speaking, to take advantage of these credits. And then the other way was to do this direct pay regime. So this direct pay essentially allows you to sit in the seat of an otherwise tax-paying person, generate a credit through the same behavior activity that a federal taxpayer would engage in to generate a credit, and then get a check for that credit written to you from the U.S. Treasury. Providing a broader incentive was the key that Congress was going after, and this was one way that they could use the federal tax code to kind of do almost like an ex post facto grant type idea where they could provide an incentive in the way a grant would actually work. But it's even more powerful than that, because unlike a grant, you're not applying, you're not trying to compete. There's no competitive process. If you do the stuff that we're talking about today, you're going to create a situation in which you're eligible to take advantage of this direct pay, or elective pay as it is sometimes called, and get that check back from the Treasury. And as Marty mentioned at the outset, we're going to talk through what the timing looks like. We're going to spend time a part of the call today talking about what the process looked like, and then we're going to talk about some of the issues and things. But to start with, let's talk about what these credits are and what kind of things actually generate the credits in the first place. So you'll see on the slide here today, a little bit of background. This is Section 6417 is what actually allows for this direct pay to take place. And for any folks that are doing the things that are going to generate these clean energy incentives, if you're a state, local, or tribal government, a not-for-profit, a U.S. territory, or other similarly situated tax-exempt entity, you can avail yourself of this opportunity. We're going to talk some about the pre-filing registration tool that exists. The IRS has created a portal to kind of help go about taking advantage of this opportunity. There are user guides and instructional videos, and you'll have those links when you get the deck later after the call. But yeah, just to reiterate, if you're a not-for-profit tax-exempt entity, you likely can take advantage of this, and it's a really powerful opportunity. You want to go to the next slide, Marty? So there are two main concepts of credits that generate these opportunities. And the first one that's up here on the screen, section 48, this is going to be the primary credit that tax exempts are going to take advantage of. It's an investment tax credit. And the way it works, high level, is if you invest dollars into qualified property or qualified assets as per the code and regulations, you get to take a portion of those dollars, a percentage of those dollars as a credit, right? So we see here on the slide, there's a base credit of 6% of the qualified energy property. And there are rules and regulations which determine what is the qualified energy property. As we'll see, for stuff that started construction prior to the beginning of this year, it's a technology-based assessment. And for stuff going forward, it's a carbon net neutrality assessment. And we'll talk about that a little bit. But the base credit is 6%. There is a prevailing wage and apprenticeship requirement that was new underneath the Inflation Reduction Act, which will boost that credit amount from 6% to 30%. And a key thing to understand there is that prevailing wage and apprenticeship requirement that applies, it's a documentation exercise, and there are exceptions to it. There are career provisions. There's a little bit of complication there. So definitely want to make sure you're understanding that and using a trusted advisor to navigate that, because it's a big credit amount, obviously, to go from 6% to 30% of your project. And we're going to talk through a little bit more. You can get above 30%. There's some really cool opportunities to get as high as 50% of your project back in the form of this direct payment. The investment tax credit is subject to a recapture period of 5 years. And the way that recapture period works, generally speaking, is that you have to, as an entity, continue to own the assets that generated the credit for 5 years. If you were to sell or dispose of the asset within that 5-year period, there's a pro rata recapture where you'll have to owe the remaining pro rata amount back to the IRS. Next slide, Marty. Thank you. All right, so I mentioned that starting this year, there's an entirely new concept. So when Congress passed the Inflation Reduction Act, these energy credits, as I mentioned, already existed, and they were technology specific for years and years and years. So if you produced or if you placed into service solar assets, for example, solar panels, solar modules, solar racking, you were generating these credits. What Congress realized is there's been a significant technological advancement that's taken place in the clean energy and green technology, clean technology space over the past 10, 20 years. And if they were to continue on that technology-focused credit idea, they would not necessarily be able to capture new technologies that come out. And they wanted to broaden the ability of these credits to provide an incentive for new technologies. And so they came up with this idea that starting January 1st, 2025, any new construction that begins now is actually underneath this technology neutral or technology agnostic concept, where as long as the technology you're placing into service is generating energy and electricity, but net neutral from a carbon output perspective, you're eligible. So it doesn't matter what the technology is. There's a lot of regulations that have come out around this as well. They've specifically called out in the regulations technologies that, for example, solar, which is just going to be presumed to be qualifying underneath this new section. And then they've also come out with new rules and regulations around how you actually measure and document that you're carbon neutral in certain circumstances. All right, so section 45Y is a similar concept from the technology tech neutral aspect, but this is the other type of credit that qualifies under these elected pay regimes, which is likely not going to be as applicable to a lot of folks probably on the call today in the tax exempt world, but definitely wanted to talk about it because it's still out there. This is where you place into service those same assets that we were talking about previously, but it changes the way you calculate your credit. instead of calculating your credit as a percentage of the dollar spend or the investment tax credit, this is now a production tax credit. So we're now calculating the amount of credit you get off of the amount of energy you produce and then sell to an unrelated third party. You can either choose one or the other credit for the same asset or facility basis, right? So you can't take both an investment tax credit and the production tax credit. And it really, if you are in a position where you're eligible to take both because you're selling the credit to an unrelated third, or you're selling the energy, excuse me, to an unrelated third party, there's some analysis to be done because depending upon the facts and circumstances, one might be a little bit more lucrative than the other. The way the PTC works is you calculate the credit that you're generating each year for a 10-year run, and you'll get that amount in each of the years. So there's a longer period that you're looking at this. There's advantages and disadvantages to both, but for purposes of this call, the idea is that they're both out there. The PTC has a base credit of 30 cents per kilowatt hour, and there's an inflation adjustment that takes place each year. And just like the investment tax credit, there's a prevailing wage and apprenticeship requirement that can apply here as well. So without getting too into the technical details of some of the technologies and a fully exhausted list, what kind of project types are generally eligible? What are we talking about here? Well, you'll see the list up on the screen. I would say that for purposes of direct pay, the ones that my team sees the most are solar, and geothermal. Wind is also out there. Landfill gas, that's eligible, but there's some rules and requirements that where for a lot of that, it's going away because of the new regime that I mentioned coming in place. Same thing with municipal solid waste. Standalone energy storage is a rising in popularity. And part of standalone energy storage, it doesn't just mean electrical battery packs. There are thermal storage applications here as well too, and we see this a lot in the tax-exempt not-for-profit space. To the extent that you are placing in HVAC upgrades or large HVAC systems, which might have thermal storage technology. So what we're talking about here is when you're generating excess heat, you store it away, and then when it gets cold at night, let's say, you release that energy, and then your that capture is much more efficient. There are applications where that's also qualifying technology for purposes of direct pay.
Hey, Tim, what about EV chargers and stuff?
Yes. Yep. EV chargers, electric vehicles, sometimes hybrid vehicles, depending on the facts and circumstances. Those are also qualifying technologies for this concept, and we see a lot of that too.
I think we probably see that the most. Like we probably see like solar and EV chargers whenever we're talking to a not-for-profit. Like maybe I don't know. That's been my experience for the most part. Maybe not the large government stuff, but I think maybe
Yeah.
NFPs, universities, things like that.
Yeah, that's a good call out, Marty, because I think that's probably that might be one of the things that people are doing the most that makes them eligible for this stuff is purchasing electric vehicles and putting in EV chargers.
All right. Only question number two. Is your organization considering any investments in clean energy? All right. This will be interesting considering that I asked this in the context of the Trump administration coming in and seeing that there clearly is a push to go back to oil and gas type investments, at least with respect to any incentives. But the question I'll ask you is, what are your thoughts and speculation on the future of the Inflation Reduction Act regime? Considering that there hasn't been any congressional action, but there will be something later this year or soon. What do you think?
Yeah, it's a great question. I mean, unfortunately, we don't have a crystal ball, and I think that it's this is even a particularly difficult time to make predictions about where the political winds are shifting with respect to legislation. But the things that we have been hearing are this: there are likely going to be some modifications to the Inflation Reduction Act to help pay for other um, things that this administration and the current Congress want to do with respect to tax code changes. However, the word that has been tossed around for several months now is they're going to be surgical, and we think there's a reason for that, right? The majority of Inflation Reduction Act dollars are moving to red states, and so there's a political push here to keep that money flowing. Two, the Inflation Reduction Act has actually resulted in a significant amount of onshoring of both American manufacturing with respect to these types of technologies and additional jobs for installers and developers. And so I think that there's enough there and enough deals that are now in process, in flight right now, that there won't be massive changes. I don't think they're going to get rid of the Inflation Reduction Act, and I don't think they're going to get rid of direct pay completely. They might take away some of these credits that are qualifying. So you mentioned the EV chargers. Perhaps they reduce the amount you get for installing EV chargers, or make some changes like that. But I don't think all of the stuff we're talking about today is going away, at least in the near
Yeah.
term.
When you talk about some of the stuff going away and how difficult it is to predict, I don't think a year ago we could have predicted the CEO of the largest EV charging company on the pushing for a lot of this stuff to go away. So it's very strange. Interesting times. Okay, we're moving on. IRA credits and deduction enhancers. David, take it away.
Thanks, Marty. So Tim mentioned a bit earlier about how you can get a credit rate that's greater than 30%. And these are some of the items that can lead to it. So the big one you want to consider is prevailing wage and apprenticeship. So the base credit rate for these projects, if we're doing an investment tax credit, is 6%. If you are a project that's subject to prevailing wage and apprenticeship, so it's greater than a megawatt for solar, you are going to need to meet these requirements to get a base credit rate of 30%. So from a financial standpoint, it's quite significant to ensure that you're getting that additional prevailing wage and apprenticeship multiplier, because it really changes the economics of the entire project. The big thing there is that there are compliance considerations with how you track prevailing wage and apprenticeship that you need to consider. And we'll get into prevailing wage and apprenticeship a bit more on the next couple of slides, but just something to be aware of. There also is this additional 10% bonus if a facility meets the domestic content requirements. Essentially, depending on the year that project begins construction, if a certain percentage of the project is sourced from domestic manufacturers, the components, you can get this 10% additional credit. Now, for tax-exempt entities, this domestic content piece begins to become a requirement in order to achieve the maximum tax credit, which is something we're going to talk about later on, but that's an important thing to note. And then we also have an additional 10% that can be generated for being placed in an energy community. So there is the DOE provides a mapping tool that you can review to see if the address your facility is located in falls within these energy communities. That tool is updated on an annual basis. So you want to always check that. There's not really much you can do about it if it's not an energy community, but if you are kind of planning projects and you're considering locations, it's a good idea to go on that website and see if one may fall in energy community while one does not. These last two here are low income bonuses. So they are for projects that are located in low income communities, but it's a little bit different because it's an application based allotment. So there is a finite amount in this pool that can be allocated to certain projects. The majority of that allocation has already been handed out. So it's unlikely that if you had not already applied for one of these low income boosters that you'd be able to obtain one, but it is something we wanted to point out. Okay, prevailing wage. So what do we talk about when we're talking about prevailing wage? So some may be familiar with the concept, but if anyone is not, prevailing wage states that any laborers, mechanics, rural mechanics employed on a project must be paid a prevailing wage, and that's based on the location of the project, the type of work that's being done on the project. The Department of Labor posts these wage rates for the various geographic locations that you use to determine what is the prevailing wage rate for that specific location. And then there also is the exception, which I mentioned briefly on the previous slide. So if a project is under 1 megawatt, then you do not need to worry about prevailing wage from the sense of getting that 30% credit rate. You automatically qualify. The only credit where that's not true is for the EV charging property. They don't offer that same exception. But for anything else that is under 1 megawatt, you don't have to worry about. But if you are over a megawatt, so you're doing a larger project, prevailing wage is something you have to consider. And along with prevailing wage is apprenticeship. So for any projects that would be starting now moving forward, 15% of the total hours on the project must be completed by qualified apprentices with registered apprenticeship programs. Now, there are some exceptions to this that we'll talk about later on, but a lot of people kind of focus on the prevailing wage piece, but the apprenticeship piece is equally as important because you have to be compliant with both to get that 30% credit rate. And this also applies to the 179D deduction for energy efficiency upgrades that might be made to a particular building. That also increases that deduction for people that are considering that.
Yeah, so these were put in place to be very pro-worker, right? The intention was like, if you're going to get this cash or the full amount of this credit, then we would like you to be paying the workers that you have on this particular project a prevailing wage across the board. And so you got both the credit and direct payment type incentives for the technology, but its intention as well was to support the workers who are doing this too.
Yeah, that's a great point, Marty. I mean, I think a lot of the things within the Inflation Reduction Act are looked at as like energy boosters, but certain components within them, like the prevailing wage, was put in there to influence and kind of create roles for people where they're paying fair rates for the work that's being done and kind of for the economy to thrive. And so what is a prevailing wage? Prevailing wage is a combination of the wage rate and any bona fide fringe benefits. And then, like I mentioned, it's based on the geographical location, and that's also based on the classification of the laborers completing work and the type of work that's being performed. And apprenticeship. So the total labor hours on the project for any projects moving forward, which is probably likely anyone who's considering any future projects, the construction probably did not begin before January 1st, 2024. So you're going to be needing 15% of the total hours worked on that project to be by qualified apprentices. Now, in some locations, it's not feasible to get apprenticeships, and they're aware of that. So there's certain exceptions that are offered in situations like that. But I just want to make sure everyone's cognizant of the fact that it's not just the prevailing wage piece. The apprenticeship piece is definitely something you need to be aware of, and making sure you're considering in the planning of the project and the financial impact it could have by not being compliant with that. So domestic content requirements. So this is a little bit of an interesting one. So for tax-paying entities, domestic content remains to be a booster to their credit, but if they aren't able to achieve a domestic content certification, it doesn't impact them in any way. For tax-exempt entities who intend on claiming direct pay, these requirements change the credit amount to a point where it phases out completely at certain points. So 100% of the steel and iron has to be domestically sourced. From what we've heard in the industry and what we've seen on projects, that's not too much of a tall order. It seems like that's something that's somewhat easy to be satisfied. The part that gets a little trickier is this manufactured products and the percentage of that, which needs to be domestically sourced in order to get the maximum credit amount. So 40% of the manufactured products in 2024 for a project that began construction in 2024, if you are not able to get that 40%, your applicable credit amount goes down by 10%. So you get 90% of the credit. And then the manufactured products component moves up to 45% in 2025, 50% in 26, and 55% in 2027. Now, the thing that's really important here to note is if we look at the applicable percentage of max credit, if not met. So in 2024, if a project begins construction, you're getting 90% of your credit amount. Not great, but it's not terrible. 2025, 85%. So a little worse, but still maybe feasible. But then we see the jump down to the 0% if you're not meeting these domestic content requirements. So that's why it's such an important factor in planning the project for anything that is beginning construction now or in the coming years, to make sure you're meeting these domestic content requirements, especially for the manufactured products. The manufactured products piece is fairly technical when you look at what actually qualifies for that and what that's established as, depending on the technology type. So I'm not going to get into that too much here, but just be cognizant of the fact that you do need to be paying attention to where you're sourcing these materials from, and if you are not sourcing them from domestic manufacturers, how it could potentially impact the credit amount that you're going to receive.
And I just want to interject real quick here, David. The other thing that's important to call out here is the effect that requirement has is determined by when you begin construction of your project. And there are ways and strategies around how you can document beginning of construction. There is a safe harbor that allows you to spend a certain amount of money on the project and then be deemed to have begun construction. So even if you might not be breaking ground for a period of time, there are still ways to meet this. And that's why it's important as you begin to plan and think about what the impact this is going to have on your potential elective pay amounts. You are working with an advisor to figure out how you go about planning that for this, and there are options for making sure you can meet these requirements beyond just getting the domestic content.
So this kind of flows right into what Tim said. So it shows you the year the construction began is the important piece here in determining kind of what needs to be done for domestic content and what the implications if it's not met. So in 2023, if a project begins, so if you meet that safe harbor or you begin construction, you qualify for a 30% credit rate. You can get a credit of on $1 million project, the credit would be $300,000. So pretty simple math. But then moving forward, if you're not meeting that, that's when you're going to see that reduction come into play. And I think an important thing to note here is that it's not a 10% reduction. So your credit rate does not become 20%. It's a reduction of 10% of the credit amount. So if you're doing $1 million project and you have normally a 30% credit, so a $300,000 credit, that 10% reduction is going to leave you with a $270,000 credit, not a $200,000 credit. So it's a reduction of the actual credit amount itself, not the credit rate that's applied. And similarly, moving forward for 2025 for projects to begin construction this year, you're going to have that 15% reduction. So it ends up being a credit of about 255,000 as opposed to 300,000, which would be the 30% rate that's being applied, but it's not a 15% credit. So it's not dropping your credit the whole way down to $150,000. Now, we do have certain factors that can apply to a project that can exclude it from needing to meet these domestic content requirements. So the first one we talked about a bit, and this is for facilities that have like an output capacity of less than 1 megawatt. So we've seen a lot of people strategize to try and implement projects of that are less than 1 megawatt to try and avoid some of the complexities and compliance that are needed with prevailing wage and apprenticeship. Even though they might be paying the prevailing wage, there is an administrative burden to make sure you're tracking these laborers and mechanics, making sure you have all the information you need if you're using contractors and subcontractors, and they're reporting it to you in a timely fashion. So there is somewhat of a compliance burden, which is kind of what we assist clients with that are doing these larger projects and making sure they're tracking prevailing wage and apprenticeship. Now, for projects that are greater than 1 megawatt, there is also an exception if using domestically sourced products increases the overall cost of construction more than 25%. So while a lot of the way the code was written or the legislation was written to pass the Inflation Reduction Act was to kind of provide stimulate the economy and domestic manufacturing, they didn't want to do it to a point where it would burden the tax exempt entities or anyone else sourcing domestically, where it wouldn't make sense from an economic standpoint for the financial impact it would have on a project. So if that's going to increase the overall cost of construction more than 25%, you can get an exception where you do not have to meet these domestic content requirements. Now, like with anything, just like prevailing wage and apprenticeship, if this is the case, you may want to make sure you properly document and run an analysis showing that it would have indeed increased the cost of construction more than 25%. It's not just running a couple numbers saying, hey, it's good, it's going to be more than 25%, because if it were to be audited, that might not be kind of sufficient evidence for the IRS that you did indeed qualify for that exception. And then the last piece is if the iron, steel, or manufactured products that are produced domestically are not done so in a sufficient quantity, or the product that's being produced is not of the quality necessary for the project, you can qualify for the exception. Now, a little bit hard to prove in the quality piece of it. It's a little bit more nuanced of an analysis you have to make to determine if it was not actually of superior quality or satisfactory quality, but quantities, that's a little bit easier to prove out. But so there are exceptions if you are nervous based on technology. For some technologies, the domestic content is easier to meet than others. For geothermal, for example, from the contractors we've spoken with, that doesn't seem to be much of an issue in getting meeting domestic content requirements for a technology like that. The one that is a bit tricky is solar. But there are a lot of manufacturers that, because of the Inflation Reduction Act, have begun to bring their production lines over here and set up manufacturing facilities, getting these factories opened up, so that is an option for people that are subject to this requirement for domestic content for the tax exempt entities, or for taxpayer entities seeking to get that bonus credit.
Yeah, and I think that's what we're hearing from a lot of folks is possibly going into next year and certainly the year after. Domestic manufacturing is going to meet a point where a lot more installers and developers in the solar space are going to be able to provide a product that's going to meet the domestic content requirements, which is awesome. It's awesome because of the requirement on the tax exempt side, and it's awesome because of the bonus 10% you get as well.
And it's probably interesting now that who knows what will be subject to a tariff any given day. So, yeah.
All right, well, we're going to talk a little bit about process. Like, what does this actually look like? How do you go about doing this? And so I'm going to walk through the next slide, and then I'm going to let I'll explain why I'm going to bring Melanie in a second. But if you want to jump to the next slide, Marty. So how does it work? So as you can see on there, a tax-exempt organization invests in all this stuff we're talking about. You've got let's say you have a building and you put solar panels on top. And now you're eligible for generating these credits and your tax-exempt entity, so you get direct pay. You place this stuff into service, and then you notify the IRS of your intent to claim direct pay, and you do that through an online registration portal. You then file, which is typically a Form 990-T, and you attach certain forms evidencing the type of technology, the cost of that technology. There's a little bit more detailed information about, sometimes the capacity, the energy capacity, how much electricity is it producing or capable of producing. And then the IRS will then send you your check back once you've filed and passed your deadline for filing that form. Now, here's the thing. David and I, I don't know if that I've ever seen a Form 990-T prior to the Inflation Reduction Act. We worked with corporate taxpayers predominantly, and so we were doing corporate tax return type work and forms for corporate tax returns. But luckily for us here at Cherry Bekaert, we have folks that are experts in the Form 990-T, and one of those is Melanie, who you were introduced to at the outset of the call. Melanie, I'm going to turn it over to you maybe for a few minutes just to briefly talk about your experience with the form, and then I'll share a little bit about how you've gone about helping our clients get this form filed now under the direct pay rules.
Absolutely. Thanks, Tim. So it's been an evolving journey with trying to file these forms with the IRS. You would think that it would be streamlined, especially since the 990 series has an electronic filing mandate. So all of the forms now have to be electronically filed or they are rejected from the IRS. And we're seeing these forms being rejected because the IRS agents aren't in tune with the regulations that were comprised to allow non-filing entities, those that are not within the IRS business master file, to actually file to claim the credits. So as I mentioned before, it's just been an evolving journey. And let me just take you through the timeline and I'll keep explaining further. So a college intends, and we're going to use a college as an example, to benefit from these direct pay for its solar installations. And the first step is to complete the pre-registration form on the IRS portal that we've been discussing. The pre-registration should not be completed earlier than the beginning of the tax period when the college earned the credit. And then after placing the investment in service is when it applies. So once the pre-registration is complete, then the college will obtain this registration number that's used when we filed these particular forms that are attached to the Form 990T. And this could take up to 120 days. So just kind of elongating the process even further. And then once that registration number is obtained, the Form 990T can be filed, and then yes, so the Form 990T is filed the year in which the asset is placed in service. So let's continue the journey. Next slide, please, Marty.
Sorry about that, Melanie. My fault.
That's okay. So the Form 990T, along with the Form 3800, and then each individual credit that the college is claiming has its own specific form attached to it. So the Form 990T summarizes what the Form 3900 summarizes, which are the details and the specific credits that are claimed on their separate forms. All of this is compiled into a nice package. And what we're finding for those entities that do not have a 990 or any type of tax return filing requirement is that upon paper submission, we have to write a letter to the IRS explaining why we're submitting this on paper, asking them not to reject the tax return, in addition to attaching the regulations that allow this paper filing to occur, in addition to the tax package. And then hopefully the IRS allows the submission to actually be processed. Now, because of the paper processing, we're seeing further delays, because when you electronically file a tax return, it's kind of an automated process and you receive a refund typically within 2 weeks, maybe up to a month. With paper submissions, however, it's becoming a 6 to 9 month wait. And then to continue on with the new administration's changes to the IRS and the reduction in workforce at the IRS, we're likely to see even further delays with tax return processing. So it's not going to be an immediate recovery of the tax credit refund, but it is coming. So patience is needed. As far as timing goes, the 990T is typically filed the 15th day of the 5th month after the tax year end. Now, you can elect, if you're a fiscal year end, to file according to a calendar year end entity. So 5/15, May 15th as your initial deadline. But there's also an automatic extension where no form needs to be submitted that allows for up to 6 additional months. So your calendar year-end filers now have until November 15th. And if you're a fiscal year, say 6/30 year-end, you have until the following May 15th to complete the 990T filing.
That go too far, or is it okay? Cool. Here's the next polling question: are you interested in learning more about how your organization can utilize direct pay? The correct answer is yes, by the way, but yes, no, or not sure. Melanie, what has been your experience with the IRS in terms of receiving refunds? I think we found that they actually came, and some of them maybe a little bit even faster than. So, despite some fear that things might really be messed up, I don't think that happened, at least in my experience, the ones I'm aware of.
And that's a terrific piece of news to offer our audience. I haven't heard of the results of the refunds other than slight delays than what we were projecting initially. It's the filing requirements and actually allowing the tax return acceptance has become the greatest challenge for my team recently.
Gotcha. All right. Well, polling question 3, are you interested in knowing? Yes, 18%. So thank you for that. And then not sure, 25%. Okay. So moving on. With that stated, credit amount determination. Melanie, thank you, by the way, so much. I think here at Cherry Beckett, the point is, and why we're having this is like, if you have questions about it or want to like have someone help with a submission and get this in place, both from a credit calculation perspective, documentation perspective, and we'll call it process perspective, which in some ways is the most complicated thing. I think we have those resources for you. So please feel free to reach out for any projects you have moving forward as you think about on your timeline. From a credit determination perspective, I don't know if it's Tim or David, but why don't we get into this a little bit right now? Is this one Tim?
Sure, I can grab this one. So to determine the credit amount, you look to, and we talked about this a little bit at the outset, right? You look to the assets and whether or not they're eligible assets. And a portion of that is determining which pieces are eligible. And the reason it's a little bit of a complicated concept, but the language that the statute and the IRS regulations actually use is functionally interdependent property. So you're looking to draw that line as to where what I have and what I'm spending money on completes the function and its purpose, and where do I go beyond that? And maybe I can clarify that a little bit with an example, right? So what the IRS says with rooftop solar is the solar modules count. So the money spent to put the panels on the roof counts. The racking or the components that hold those modules counts. So any costs that I spend to put that on the roof count. But the roof itself or the replacement of the roof itself doesn't count because the roof's function is separate from the solar module's function. And so there's an analysis to be done, especially with some of the more complicated pieces of property, as to where do I draw that line with the costs and include my qualified costs versus costs that wouldn't otherwise be qualified. One of the other pieces that we look at is how are you financing or where are the funds coming from to purchase the asset. And this can be an important part of the analysis as well, because there are rules about if you are using certain grant type money towards purchasing these assets, you have to do a calculation. Now, this is a different calculation that takes place in the tax exempt space versus the taxpayer space. In the taxpayer space, there's an entirely different way of looking at this. The good news is it's more favorable in the tax exempt space. The tax exempt rules say your grant monies specifically for those assets plus the credit can't exceed the total cost of the qualified assets, which means there's a world in which you could potentially get these things for free. You just can't get above and beyond that benefit. And so you have to reduce your credit potentially by the amount of dollars that would be over the spend on the total spend on the asset. There's also a look at the applicable credit rate. David walked us through that. So how are we determining, are we hitting prevailing wages? Do we get the domestic content bonus? All of those types of things, those play into the analysis. And then there's some other factors, and I mentioned some of these as well. When did you begin construction? So what rules apply to you based on the date you began construction? And also what rules apply to you based on the date that you place the asset into service? And how do we take the IRS's rules for determining those things and apply them to the facts and circumstances of your project? And I talked about this a little bit. This is just a great slide for kind of walking through this concept of a couple of common technologies that we see and what's a qualifying cost and what's not, right? So you see the solar example right up there, the panels versus the roofing. We have similar stuff with the geothermal, right? So if you have existing HVAC ventilation ducts in a building and you install a new geothermal system to heat and cool that building, the pumps for the geothermal system and the well system are going to qualify, but those existing ducts, or even if you replace those ducts as part of the project to put the geothermal in, those ducts aren't going to qualify. You can move to the next slide, Marty. Same thing. One back, please. So same thing with the financing mechanism. I already kind of walked through this, but when we look at different types of facts and circumstances around contractually what's going on, there can be some analysis that needs to take place to figure out what the proper credit amount is. I mentioned grants and other subsidies on here. You can see where there can be impacts by leasing arrangements because the IRS, and this is something difficult, especially for folks that don't deal with the IRS a lot. Terms of art that you might hear in general business are very specific sometimes in the IRS code. So when the IRS says a word like owner of the property. It's not necessarily what even the legal owner is in that jurisdiction. It's what the IRS considers to be the owner of the property. And so when there are leases in place, we have to look at those leases and say, is the IRS going to look through this lease and who are they going to consider to be the owner of the property? In the same way, there are special rules around debt financing and tax exempt bonds to the extent that they're used to fund the project. We also might have to adjust the amount that we're using, the qualified costs a little bit to determine what the proper credit rate is, or credit amount is, excuse me. So the IRS has released final regulations across the board on this space. There are hundreds of pages of regulations now, and they cover the technical piece of what is and isn't an investment tax credit and how we calculate these rates. They cover the 6417 rules. And there's some important pieces on here. One of them is that an excessive payment. So if you make a mistake and you claim more direct pay than you were actually eligible for, can come with an additional 20% owed back to the IRS. So it's really important that you work with somebody that knows how this stuff operates to get the amount right, because if you get it wrong, it can be more than just paying them back what you took. You can owe them even more than that. It's also important to properly document this thing. So, we mentioned the prevailing wage. If that applies to you, there are affirmative requirements on when and how you document that those prevailing wages were met. And if you don't do that, you can lose a substantial amount of credit. And the final bullet's important, right? There's no requirements on how you utilize the money you're getting back. Once you get that check back from the Treasury, that's your money, and there's no lingering requirements of what you do with that. We kind of walk. Oh, yeah, we kind of walked through this a little bit already, and Melanie kind of talked about how this looks. I mean, this has some kind of dollars and cents to it, I guess. So you go out and you spend $3 million on solar panels on your buildings. Let's say we're sticking with the college idea, right? And you want to make sure you get the maximum credit possible. Part of that credit validation exercise is to review the technology that's eligible for the direct pay. Make sure that you track your prevailing wage and apprenticeship requirements, like we talked about, to the extent they're applicable. Make sure you're properly completing your pre-registration form in a timely manner. And then filing the form on time as well, right? Because you have that window after you've done this to file a form. If you miss your window, you're out of luck, and you're going to leave a lot of money on the table for something that you would have otherwise gotten a payment back. In this case, for a $3 million solar investment, it could be a $900,000 check back from the IRS for the amount of dollars you spent.
Tim, this is like different than we'll talk like a taxable person, like who could go back and do an amended return, right? And would want to like take advantage of it. This is more timely. It has to be done like in that year of, right?
That's exactly right. You're not going back to amend. If you don't make the election and file the form within the window that you're given to do so, depending on your facts and circumstances, you lose your ability to take advantage of this. So it's important that you're keeping track of your projects. And I think if it's not the next slide, it's one of the next slides. We're going to talk about our approach to this. Well, yeah, our information request. So Sherry Becker, here at our firm, we do this for free, where we kind of take a holistic approach of asking what you have going on from a project perspective and what you might be planning or thinking about or looking at putting into your budget in future years, to figure out whether or not you're going to be eligible for this stuff, so that you're not missing these deadlines and you are getting the appropriate amount of money back. And we have found with some of our clients where we've identified projects and amounts that they had already begun construction on or were about to begin construction on, and did not even realize that that particular project or a portion of that project was eligible for this direct pay. So it was really nice to be able to come to them and say, you're going to get a check back from the U.S. Treasury if you go through with filing for this thing, and you're going to be sitting on more money than you even thought possible. The other, in a similar fashion, we've done this and found that folks knew that direct pay was out there, thought they were getting a check, and the check was actually a lot bigger, because I talked about that functionally interdependent test. They weren't applying it correctly, and there was an additional multi-millions of dollars available to them to get back in the form of a check that they hadn't already identified. So what you see on the screen is typical of the questions we would ask, and we scope this stuff for free here at Jerry Becker, where we'll come in and look at this and then and figure out if it's worth us working with you to go after these credit amounts.
All right. Only question 4 as we come to the end of this thing. Would you like a team member to reach out to you after this webinar from Cherry Becker. Again, the correct answer is yes to this. But with that said, you have yes, no, or maybe in the future. Obviously, it's going to depend upon what you have going on at your particular organization. Um, Tim, David, and I are focused on the technical and the costing and understanding exactly what credits are available and when beacon construction can needs to be applied, domestic content enhancers, things like that. Again, I think the true enhancer for us here is having someone like Melanie, because I know what's going to happen. They're making so many cuts at the IRS. You're going to need a partner like us, someone like that, who can help make sure that you're filing appropriately. And then also having maybe some touch point who can go back and forth with the IRS a little bit, because I just feel that this is a new program and people were just learning it. And then certain people are being let go and no one's going to know what's going on. And so you're just for your sanity, you're going to want to you're going to want to yell at us instead of at the IRS. So we'd be happy to do that and like listen to you about how we can like be an interface there and figure out what's up. Melanie and Tim and David, I want to thank you all very much for participating today. This is going to conclude the webinar. Again, thanks for joining us. Reach out at any time, as I was saying. We do value your feedback. If you take part in a short survey, we'd certainly appreciate that. The recordings will be available in about a week. But I hope this has been beneficial for you. It certainly has for me, and I'm very proud to work with this team. So thank you all very much.